Hey everyone, this week I'm going to highlight some of the key third quarter performance metrics for apartment, office, industrial, and retail properties. Now, on a national level, third quarter apartment vacancy rates ticked up to 4.6% as housing demand stepped back from the exceptionally strong levels of the past few quarters. It should be noted, however, that even though the vacancy rate did edge higher in the third quarter, the overall rate is still 100 basis points below where it was this time last year. The greatest challenge for the apartment market has been the significant wave of construction. Markets with a lot of new multifamily units coming onto the market like Austin, Dallas, Charlotte, Denver, Nashville, and Phoenix continue to face lease-up headwinds. That said, the development wave looks like it's finally beginning to abate, and the markets with a lot of new units tend to have very strong economic drivers. So the overdevelopment headwinds should stabilize soon. Metros with limited multifamily additions like Chicago, Cincinnati, Cleveland, Detroit, Minneapolis, and San Francisco outperformed in terms of rent growth. These markets delivered rent gains north of 5% over the last year. Now, that's really solid growth in the current cycle. Next up, office. The office market delivered its sixth consecutive quarter of positive net absorption with nearly 38 million additional square feet filled. That helped pull the national vacancy rate down by an additional 30 basis points to 16.4%. Markets with the most significant vacancy improvement over the last year include San Jose, with a vacancy decline of 230 basis points to 17.7%. The vacancy rate in New York has fallen by 210 basis points since last year to 14.3%, while Milwaukee locked in a 170 basis point reduction to 16.4%. Orange County's vacancy rate fell 160 basis points to 15.3%, and Kansas City declined 150 basis points to 12% vacant. The markets with the lowest overall vacancy rate include Riverside, San Bernardino, Miami, Cleveland, Tampa, and Indianapolis. Now, industrial space. Demand for industrial space climbed back into positive territory in the third quarter with nearly 20 million additional square feet filled. Nonetheless, industrial completions remain elevated, surpassing net absorption to drive the national industrial vacancy rate 20 basis points higher to 7.8%. That's the highest vacancy rate since 2013, but this is really all about construction. In the last 10 years, about 3.5 billion, with a B, square feet of industrial space has been added. So even though construction has been tapering over the last several quarters, the market is still trying to digest all of that new space. That said, construction has been highly concentrated in markets like Riverside, San Bernardino, Houston, Atlanta, Phoenix, and Chicago. These metros and other major port and transshipping hub markets had the greatest influx of big box industrial space additions, which is driving up the vacancy rates. On the other hand, numerous metros only had minimal construction over the last several years. So several metros, particularly in the Midwest, still have exceptionally low vacancy rates. Minneapolis, Cleveland, St. Louis, Detroit, and Louisville lead the nation with the lowest industrial vacancy rates. Next up, retail. So, retail space demand was modestly positive in the third quarter, following 2 quarters of negative absorption. That said, the overall retail vacancy rate nudged up to 4.9%, which is still below the long-term average. Vacancy rates are lowest in northern New Jersey, Boston, Indianapolis, Miami, and Minneapolis, all of which are below 3.5%. Most metros, however, have seen a modest uptick in vacancy rates over the last year, but unlike apartments and industrial, the rise really hasn't been driven by development. It reflects a bit of a slowdown in the pace of leasing as the impact of uncertainty, tariffs, and slowing job creation have caused many retailers to throttle back their expansion plans. That said, well-located space, especially in centers with a higher concentration of necessity or experiential retailers, remains in demand. Barring a recession, as trade policy stabilizes and uncertainty abates, retail vacancy rates should once again begin to trend lower. So, all things considered, commercial real estate fundamentals performed pretty much as expected in the third quarter. Uncertainty, together with the weakening employment market and elevated development in some property types, acted to restrain performance. Looking forward, if a recession is avoided and uncertainty abates, the outlook could strengthen considerably. But there's still a lot of uncertainty, which is why investors always need to keep their eyes on the horizon.